So let's begin. Welcome to the webinar on how to create a good trading setup using which we can initiate some trades or even we can automate it through algo trade. Right? So in the previous webinars, I have already spoken about algo trading and what algo trading is all about, what are the benefits of it, and many of you are already associated with us and you have already started doing algo trading, right? So today we will look at some of the technical side of things, wherein we will understand what is indicator, and we will also look at a visualization tool that is most popular around the world, which is called Trading View, and how do we analyze the movement of the market and try to find out some profitable trades using some indicators. So without any delay, let me share my screen and get started with that. So basically, the agenda for today's webinar is to look at the different kind of analysis we can do in the market. We will specifically focus on what is technical analysis, and we'll try to do some technical analysis using Trading View on the historical data for any asset. We'll try to define a strategy on the basis of which we can do trading, and we'll sort of do a back testing as well, wherein we will see how profitable that strategy is over a period of time. The Indian stock market specifically, there are many things that you can trade. So it's not just limited to stocks or any of the other regular investment moves, but you can trade a lot of these assets like mutual funds, commodities, derivatives, currency. Then you have a lot of ETFs, which are called as exchange traded funds, shares like equity of any company, right? So shares, you can say there are two types of shares. What you deal in stock market are called preferential shares, because preferential shares does not give you voting rights in the company affairs. And then you have government bonds and debentures. There are also private funds, which are often traded by many houses. We will focus specifically on index data, which is either Nifty, Bank Nifty, or you can see there are about 6 tradable exchanges that we have in India right now. Right, so most popular are the Sensex, which is an exchange of the top 30 companies in India. Then you have Nifty 50, which is an exchange of the top 50 companies in India. Then you have Bank Nifty, top 12 banks combined together forms Bank Nifty. And these are 3 most traded exchanges of now, right? And you can do trading of futures and options on these indexes. And that is what we will look at today. Okay. Now coming to the different kind of analysis that one can do, starting from fundamental analysis. If I want to do, let's say, some kind of trading, then how do I come up with a strategy? Because in order to make a trade, it should not be like a random call that, okay, I think the market is going to go up, I will buy. I think the market is going to go down, I will sell. So it doesn't work that way. Because if you do that, randomly deciding to buy and sell, more likely than not, you will end up in losses. So there has to be some sort of research, some analysis that has to be done on the historical data, which will lead to a higher probability of selecting a profitable trade. And there are 2 types of analysis that mostly people do. One is called fundamental analysis, which is to look at the fundamental side of the company, like their balance sheet, their order books, their market sentiment, the average growth of that industry, So it's basically an investment decision taken purely on the basis of an outlook, a perspective for a company. So if I think that, let's say, Reliance has a good order book and they are going to grow in the coming years, so probably I'll go and buy Reliance shares, because in that case, the share price will increase and I will have some probability of making a profit. So fundamental analysis does not involve looking at the price movements, what has been the historical price for any asset, but instead looking at a whole view of the company's performance and deciding whether to invest in it or not. So it involves analyzing companies' financial statements, economic indicators, industry trends, the management quality, and various factors that assess the health and the potential for growth of that company. Right? That is what fundamental analysis is. While on the other hand, technical analysis is what people mostly prefer to do when you're trading. So fundamental analysis is done by people who want to invest. Means they buy those shares and hold it for a very long duration, maybe a few years or maybe about a 5 years or 10 years horizon. They don't want to buy, sell regularly. They want to invest some money and hold it for a longer duration. That's when fundamental analysis is useful. But for those who want to do trading, that means I want to frequently buy and sell. I want to identify some quick and short-term opportunities, cash in those opportunities and move to the next one. I cannot hold anything for longer duration, let's say because of my trading style, or I do not want to hold a certain amount of stocks for a long duration. I want to be profitable in a very short period of time and move on to finding some other opportunities to invest. That's why technical analysis is more popular. So technical analysis is a way of looking at the price movements, right, for any stock or any crypto or any currency or any of the asset that you're trading. What has been the historical movement of prices? Daily basis, on an hourly basis, on a monthly basis. So you look at the movement on various time frames. That every 5 minutes, what has been the movement of prices? Every 1 hour, what has been movement of the prices? And based on that movement, you try to find some patterns, some statistical analysis, apply data science skills to build machine learning models and use AI tools in order to find the right entry points and exit points. In short, technical analysis is about understanding what has happened in the past using the historical data and assuming that similar patterns might evolve in future. You try to predict that and take a trade on the basis of it. Our goal is to do trading. We do not want to keep invested in one asset for a very long duration, but we want to identify opportunities very frequently and cash in those opportunities as much as we can. So we'll primarily focus on the technical side of things. We will look at the price movements, try to identify some patterns and see how those patterns can be useful for making those decisions. Right. So in technical analysis, there are many ways in which one can look at the price movements. Some of them are listed on your screens, like they look at the simple price charts. As I said, the movement of data over various time frames, movement that creates patterns. Then you have a lot of technical indicators that are used, which we will be using today. Some mathematical calculation done over the price movements, which helps us identify a few key price levels. Support and resistance are basically some dynamic zones in the market where you will find supply and demand. Then what is the trend of the movement? Are the prices going up? Are the prices going down? Or they are not moving in either direction? They are range bound. Then people also do volume kind of analysis, like how many people are buying a certain stock. If there is more interest, that means there's more demand. Prices are likely to go up. It's purely based on the supply and demand theory. When the supply is limited, demand is high, prices will go up. And vice versa, when the supply is huge but there's no demand, prices are going to go down. And stock market price movements are purely based on that. Then we have something called momentum. So in trading, basically, I personally follow two golden rules. One, stay with the trend. So it's very important that you identify the trend of the market, because if you trade with the trend, you are more likely to be profitable. There's a higher probability, there is a higher chance you will end up in profit. So identifying the trend of the market is very important, and there are many ways to do that. We'll be looking at a few of it. And the second golden rule is understanding the momentum of the market. Well, the market might trend, how strong that trend is, how quickly price moves in that direction. That's called momentum. So if I have to draw some pictures, say an upside movement probably can look like this. You can say in this one, the price is moving upside, so it's a positive trend. What if the price movement looks like this? This is also a positive trend, but in a very short period of time, the price has moved a lot. This is what is referred to as momentum. That you want to identify such zones where there is a clear indication of a trend, either it's on the upper side or on the downside. You want to be with the trend, plus you have to identify areas of momentum, that where the prices are moving very sharply. Because if it is growing slowly, the objective of derivatives are not met, because derivatives are time-bound instruments. You do not have much time when you want to deal with derivatives. If you are buying something and the price is slowly and steadily moving and it takes, let's say, 5 months or 6 months in order to reach your target, that's basically not trading, that is investing. Then technical analysis is not that useful in those cases. Technical analysis is useful when you want to identify these kind of movements. For a very short duration, the trend is strong and you want to ride that momentum. You want to be with that trend by using some technical indicators. We'll be using a few indicators, exactly 6 indicators that I will give you today in my trading setup, which will help you identify both the trend of the market and the momentum. So you will get a better idea of the market movement. And then there are a lot of other technical analysis people do, which are more complicated and advanced. So today we are not going to focus on many things. We will keep it simple. We'll probably focus on these 2 things. One is your trend and the second one is the momentum. How to find the trend, how to find the momentum, and then how to use it for our benefit. Okay. Any questions? You can type it in the chat box and I will take it up in between during the explanations. Okay. Now, moving to a couple of technical indicators that are used very popularly by traders around the world. These indicators are categorized into four buckets. In the previous slide, I mentioned there are different ways of analyzing the market. There are different ways of looking at the market by using these indicators, right? So one is volume. We look at the number of people trading that asset, how many orders they have placed. There are a few indicators. These are the few indicators that you can use in order to identify those volumes in the market. Then there are some trend-based indicators, and one of the most useful trend-based indicator is a moving average calculation. You look at the average price for the last n time period. Like if we are looking at a movement of 5 minutes, then probably we can look at the average of, let's say, the last 10 5-minute closing prices. That over the last 15 minutes, what is the closing price average? That will indicate a nice and a good trend. Moving average with a smaller window of average gives you a short-term trend, and with a higher window gives you a long-term trend. In order to identify a short-term trend, people mostly prefer to look at a 9-window moving average. That means for the last 9 candles, what is the closing price? Take an average of it. Or a 20-window moving average. What is the average of the last 20 closing prices on a 5-minute candle? So those are short-term moving averages. If you want to identify long-term trend, that means for a longer duration, what has been the trend of the market, then you can go ahead and look at 100-window moving average or 200-window moving average. And moving averages can be calculated based on the time series concepts in a simple way, in an exponential way. There are 2 ways in which you can calculate moving averages. Right? So that needs an understanding of your time series. There are volatility based indicators like the momentum I said. You need to find areas of momentum, in which direction it is going to go and how strongly the price is going to move. That indication is given by the volatility index in India, which is popularly called as India VIX. So if the value of the India VIX is high, that means you have high volatility in the market. There are very sharp movements happening, like we saw during the election result day. So one day prior to the result, when the exit polls were announced, market was up by like around 4%, 5% in a day, which is not a usual movement that you see. It's a very rare situation where the market moves 5% in a day. Maximum times you will find the market to be moving within 0 to 2%. The next day, when the actual results were announced, it was down by 5%. One day it was up 5%, one day it was down 5%. That means the total range it created was almost around 10% range within just 2 days, which is not normal. So how do you identify these kind of movements if they are likely to occur in future? What are the indicators? So most popular is the volatility index, VIX. Then you have some momentum based indicators which identifies the momentum. Is there a momentum building up, or is the movement sideways because there are not many contracts being traded? Not many people are interested to trade that asset at that price. So you will get an indication of the momentum using a couple of these indicators like RSI or the CCI. These are the 2 popular indicators in that particular category. Right? So with that understanding, let's go to trading view. Understand a couple of concepts and then we will try to add a couple of indicators and find a good trading setup, right? So what is trading view? Trading view is a tool where you can visualize the historical price movements of any asset around the world, not just the Indian companies' prices, but any company around the world, any stock index, any market, you will find the data on trading view. It's free to use, but up to a certain limit. If you want to do more analysis and a higher end, more technical analysis, then you have to buy the subscription. So trading view looks like this, where at the moment the chart that I have plotted is for Bank Nifty on a 5-minute interval. These are called candles, right? Each one of these blocks that you see, these are called candles. Japanese candles, because it was first used in Japan, where you can see it looks like a visual technique of a box plot. You have a box, you have these lines which are called wicks. You can also call them as shadows. Green color candle, as it seems, indicate a bullish movement. Bullish movement means the prices went up. And a red candle indicates a bearish movement. That means the prices went down. So when the candle is green, the open of the box is the open price. The end of the box is the closing price. Wick on the top is the high. And the wick on the bottom is the low. That means since we are visualizing this on a 5-minute time frame, what happened to the price of this asset, which is Bank Nifty, on a 5-minute duration is plotted by this candle. So what you see is something referred to as OHLC data. Open, high, low, close. So within that 5-minute duration, whatever was the time, like it was a movement from 3 p.m. to 3:05. During that 5 minutes, this was the lowest price of Bank Nifty. This is where the price opened on 3 p.m. This is where the price opened or closed at 3:05. This was the highest price it went to within that 5-minute duration, and this was the lowest price. So this is referred to as the OHLC data. And that is what we see in the previous time intervals too. So you can see the time intervals are all in 5 minutes. Because each candle here represents a 5-minute time movement since we've selected a 5-minute chart. You can select multiple time frames, beginning from 1 minute to 15 minutes, 30 minutes, 1 hour, a day, week, month, year. So it is up to you what time frame you want to analyze the movement of any chart or any asset. Okay. So what we have here is the price movement. Sorry. What we have is the price movement for Bank Nifty on a 5-minute duration. Now, the first thing that I want to discuss is why do you think in this movement the prices are saturating? can we identify a few zones, a few areas where the price is not moving much? Like we can see, one of those is here. This is a price where the movement is continuously testing, but it is not able to breach. On the lower side, we can say this looks like one of those zones where the price is trying to go down, but it is not going down below that. These lines are basically referred to as key levels. The key level of prices, that means 52,660, which is corresponding to this upper line, is a key level, and 52,480 corresponding to this bottom line is a key level. But looks like the market is saturating at these points. So when the market is going up, it is going up to 52,660, but it is not able to breach it on the upper side. And when it is going down, it is testing 52,480 or let's say 52,500, but it's not able to go down below that. So these are some levels where the market is trading. These are called key levels, or more popularly referred to as support and resistance levels. In other words, demand and supply. Like the levels at which the price is not able to break upside, these are called resistance levels. Market is resisting these price points, not able to breach the resistance. And this is also referred to as a supply zone. Supply zone means people are ready to sell at this price level. So when supply is available in the market, rates always saturate or they go down. When there's a supply bigger than a demand, prices are not going to go up. Right? That's the normal demand and supply theory. So resistance is where the supply is. That means those who have bought at, let's suppose people have bought here. Now they also want to make some profit, so they'll be selling their position. There will be some place where they will sell, they will put their orders. So these are those supply zones where these people who have bought previously are ready to sell. That means they are not expecting the market to go above this price. So they are selling it here. And similarly, vice versa, on the opposite side, the price levels where the market is not able to breach on the downside, this is called support. Or this is referred to as a zone of demand. Demand means this is a price at which the buyers are ready to buy. The traders have a long position open. Long position means a buying position open at this price. So there's a huge demand. And in stock market, there's a fundamental rule. A buyer has to meet a seller in order to complete a transaction. So if you want to buy something and there's no one to sell, you will not be able to buy that item, right? That's how normally any business transaction works. There has to be a party on either side to complete a transaction. So if I want to say I want to buy Bank Nifty at 52,500, but nobody is ready to sell, I will not be able to buy it. Maybe let's say people are saying, okay, we will sell you at 52,550. It's like an auction. You say, no, I'm going to stick to 52,500. Somebody else will go and buy 550. They'll have it, and then probably the next seller that is available is at 600. So many people are ready to sell you at these levels, but you are ready to buy at this level. You wait for some time, you don't get your price. What do? You increase it. So you buy this one. Similarly, more and more buyers come and buy at higher prices. That drives the price. Again, the same demand and supply theory. So these levels that you see, resistance and support levels, are alone one of the best indications of where the price are likely to go. At what levels you should wait to take a trade. And these support and resistance levels are not something that you identify like we have done in this case. That you can look at it visually and say, okay, these looks like some dynamic resistance and support levels where the market is honoring these levels. Market is not able to breach these levels. But there are certain mathematical calculations behind these levels. You don't have to do all those calculations because TradingView offers support of thousands of indicators that are pre-built. All you have to do is find them and apply them to the chart. It's like when you are analyzing any data set using Python programming or R programming. You can write Python codes, R codes, and there is a support of a lot of libraries from where you can import those classes and functions and start using them. So you don't have to code it yourself. Same way with TradingView, when you want to analyze, a lot of things are available because it's a open source tool. While they have subscription plans, but it is freely available to all for some basic analysis. And what we are doing right now is a basic analysis that does not involve any kind of subscription. Right? So how do we identify these support and resistance zones? So all we have to do is go to go to this indicator tab on the top toolbar, right? So you see this indicator section. This is where you will find all the indicators. You can also press a keyboard shortcut of /. It will open all the indicators, matrix and strategies view. And all you need to do is just say pivot points. Pivot points is what you have to apply to your chart. Pivot point is another name for support and resistance combined. That these are some key price levels where the market is likely to stabilize. So once you click on that, you can see there are a couple of lines that are plotted here in orange. From the pivot, which is nothing but an average of the candles. Then based on some mathematical calculation, you have the support. So there are multiple levels of support. So on the 5th of July, which was the last trading day, we can see how good the price negotiated these levels. So you can see that the price did not break the third support. While with the open of the market, it broke the second support. So this was the first level that the market broke. It went down to the next support and honored it for a very long time. Went up. Now support, because it is going up, it becomes a resistance. You can see that it was not able to break that resistance for a very long time. It was testing the resistance, again bouncing back. Testing the resistance, bouncing back. Then it broke that, went down, and then it honored it again, finally breaking it. So these are some important levels where you see the price will fluctuate a lot. It will take a lot of people and a lot of trades in that direction to break these levels. This is the first thing that you have to identify on any day. Just open any chart of any of the asset you want to trade, go to indicator and apply pivot point so that you get an idea of the important levels. It was not just on the 5th, but if you also look at the movement on the 4th. So this was the movement of Bank Nifty on 4th. It broke the pivot point, went down. It was down for a long time. Once it crossed it again, it tested, but it was not able to breach. So this probably is the best buying zone. If you buy here, you can see because it tested this level, it was not able to breach it. It went up. Similarly, if you go back one more day, you can see that resistance was properly used. Market tested the resistance multiple times, but it was not able to go above it. Even the previous day, it broke the support, went to the second support, and then it was not able to break that first resistance. Every day this will happen, more often than not. You will be able to identify the right movements based on these pivot levels. So the first thing is identifying the levels where the market is likely to trade. So now you know that, okay, this particular Bank Nifty stock is likely to trade between this level and this level. So I have to take trade at these prices. So you got a indication, right? That's what the job of an indicator is. It indicates some information about the prices. Pivot points indicating key price levels where the market is likely to rebound, or what we call it as a reversal. This is something that you can apply to any chart, right? So right now it is on Bank Nifty. Maybe if you want to apply it to Nifty, so I will select Nifty here. You can see that support and resistance levels are properly used for any price movements, be it Nifty, be it Bank Nifty, or any other. So let's suppose if you want to look at Sensex. So this is the movement of Sensex. Can be applied to anything. I'll go back to Bank Nifty. So the first thing is done, which is identifying key price levels. The next is to identify trend. One of the indicators that I mentioned to identify trend is a moving average. So just like we applied these pivot points, we'll go to the indicators and type moving average. So you can see there are a couple of moving averages that you can use. You have moving average exponential, moving average simple. These are the two most popular indicators that can be used. So I'll not get into the detail what is the difference between the two, but right away I will add exponential moving average, which is better one to use in case of stock market. So I'll select the moving average exponential, which is in short called as EMA. You can see by default, it chooses a window of 9. It says EMA 9 close. That means the blue line that you see is the average of the last 9 closing prices. You get an idea of a trend that it is on the 5th falling, and then the price is just going up and down above or around that line. So short-term trend was mostly sideways. It was not moving upside or downside much. In the beginning of the day, it was a downtrend, which is evident from the direction of the blue line coming down, and then it went sideways. It was not moving up or down that much. It was in a range. Towards the end of the day, it started to go up. So basically, towards the end of the day, it was kind of bullish, and in the beginning of the day, it was kind of bearish. And throughout the day, it was sideways. This is sideways. This is a short-term trend. But if you want to look at a long-term trend, We can go into the settings and change 9 to 200. I want to look at a 200-day average. Let's say I increase the width. Now you can see the direction of the blue line has changed. It's showing the line is going down throughout the day. That means on the 5th, market was mostly bearish. And since the price is also trading below that line, it indicates that on the 5th of July, Bank Nifty was bearish. The trend was downside. So if there is any trade that I have to take on 5th, it would be a sell. I will not buy anything on a bearish day. And similarly, I will not sell anything on a bullish day. Like on the 4th, this is the 4th of July, you can see the price is trading above the blue line. That means on 4th, market was bullish. It was positive. So if I had to take a trade, I will always buy. On the 5th, market was below that line, so it was bearish. So that is where long-term trend helps you identify a good trend. What is the trend of that day? Is it upside? Is it downside? And you can also use this as a dynamic support and resistance. Like we can see the market was bearish, it was going down, it was below the moving average, and it went up to test that moving average and came down again. So here the moving average line also acted as a resistance zone. There was a support and resistance already plotted. This acts as an additional confirmation that this is where the market will test before it breaks the price and changes the trend. Because changing the trend is not so easy for the market. Market mostly remains in the same trend for some time. It doesn't change its trend very frequently. So to change the trend, it needs a lot of momentum. It needs a lot of push, either from the buyers or the sellers, to move the market in that direction. So if the market is downside, it will take a lot of buyers to push that market up. And these moving averages are always going to test that. Because those who would have bought here probably would have sold again. That is why you see the market falling. Right now we've looked at two indicators. One is support and resistance, where the objective is to look at the range at which the market is likely to trade. And then a moving average, which is an exponential moving average, EMA, on a 200 time period, which indicates trend of the market, whether it is on the upside or on the downside. And we will always stay with the trend to take that trading decision. Right? As it is said, trend is your friend. So you will always be with it. The next thing that we will apply to this chart is another indicator as parabolic SAR. Right, so you can note down this name of the indicator. It is called as parabolic SAR. And this is the one that we are going to apply. Parabolic SAR built by this developer, Everget. And it shows how many people are using this script at this moment. So there are more than 4,500 people who are using this actively on their chart. This parabolic SAR is basically an indicator of shift in momentum. So when you apply this parabolic SAR, you can see there are some buy and sell zones plotted on the chart. this indicator helps you in identifying is a short term momentum. Is there a short term momentum building in the market on a particular side? Like we identified that on 5th of July, there was a downtrend because the price was below the moving average. So one thing is clear, we are always going to sell. We will not buy because it is a downtrend. Now, if you look at the beginning of the 5th of July, right? So this is where it started. If you look at the beginning of 5th, the parabolic SAR was already in the selling zone. That means it was already saying the momentum is building towards downside. It started from the previous day itself. We know that the price is in downtrend. So we can easily sell and we could have got a good movement on the downside. So if let's suppose we wait for the first candle to close, we start selling here. If this is sell position, look at how much profit it would have given us. This was the potential profit. We will not buy because the price was below the moving average. So we identified as a downtrend. So we will not be using a buy signal. Again, there was a sell signal indicated here. So we will probably sell it. Wait for the market to go down. Once the indicator changes to buy, we'll probably close our trade. So the first thing that we look at is the range of the market, where the market is likely to trade, is what is the support, what is the resistance. Secondly, identify the trend of the market. Is the market on that given day on a downside or on the upside? If the price is very close to the moving average, we say that's a sideways movement. Like if I show you one of the past data, we can see the price is clearly either above or below, right? So indicating that particular trend. But take a look at this day. This was Monday, the 1st of July. Look at this zone. The price was very close to the line, going up and down very frequently. So this is where I will not take any trade because there's no clear indication of the trend. I want the prices to be like this, which is far away from the line, either on the downside or on the upside. But I will not take a trade in this kind of a zone where the trend is not clear. So it's better to not trade than to take a loss. So you always have to identify where is the price, how far it is from the moving average line. If it is very close to the average line, do not take a trade. That means there's no clear indication of a trend. It can go either side. But when you see the prices away from the line, it is a clear indication that trend is available or it is visible in the moments. And this parabolic SAR, which is a short-term momentum building indicator, indicates where the short-term price movements are likely to be. Is it going to be on the upper side or is it going to be on the lower side? So here the price was below moving average. That means we are always going to sell. Market started here where the parabolic SAR was already on the selling side. So we went ahead and created a position for sell and it had a good opportunity. Precisely, if I open a position here, let's say my stop loss I'll keep at the high of the previous candle. Look at the risk to reward ratio that it gave us. So focus on this number here. So it gave us a risk to reward ratio of 3:1. That means the stop loss was 127 points. That if I'm selling here, I'm setting my stop loss at the high of the previous candle, which is 127 points. In return of that 127 point risk that I'm taking, I will be earning around 400 points in profit. So it was a good risk to reward. Usually we do trading with a risk to reward ratio of 1:2. So whatever amount of stop loss we have, we take double the target. So even if we have a 50-50 win ratio, that means 50% of the time we win, 50% of the time we lose, we are in profit. Even with a 60-40 win ratio, we are profitable. That means 40% of the times we win, but because our risk to reward is 1:2, we earn 80% and we are losing 60. That means we are still profitable 20% of the times. Not always you are going to get a profit, but what we need to make sure that we keep a trade in a risk to reward ratio of at least 1:2, so that even if our win rate is very low, that means even if we win only 4 trades out of 10, we will still be profitable. What is referred to as risk management. Okay. So couple of things to repeat again what we've done so far. First, identify the trend by using a moving average, exponential moving average of 200 days window. We use the pivot points to identify the support and resistance zones. And then we also use the parabolic indicator, which indicates the short-term momentum on which side that momentum is building, whether it is building on the upper side or on the lower side. And accordingly, we place the trade to see how effectively it works. This was one opportunity that day where we sold and made a profit. Again, let's suppose if we are just going to take one trade a day, we got that trade within like 1 hour of the beginning of the day. If we go to the previous day, price was above the moving average, so we will only take a buy order. So if you look at the price, if we are only going to take buy, this is where parabolic indicated that a momentum is building towards upside. But since the price was just close to the pivot point, we have to wait. That is why the resistance and support levels are important. So this was the resistance for the market. So once it crosses, let's suppose I start buying on this point. The previous low as my stop loss. Went up. Although the SAR said bullish momentum is gone, but the price did not cross support and it went up again. How much points we would have made in this one? Let's say I buy here. Loss would be somewhere around at this point. So I'm risking 70 points. And the target that we are going to get is, say we go up to this point. So there was a potential of a risk to reward of 1:3 again. Go back.
It's 6 o'clock.
On the third. So on the third as well, the price is on upside because the price is above the moving average. Parabolic SAR saying this is where a momentum is building towards upside. So I will right away buy at this point. Let's say I will wait for the signal. I will buy at the closing of the next. Keep my stop loss on the lowest point. So let's say this is where my stop loss is. This point. and I will see how many points we were able to capture. So let's say we were able to capture up to this point. So this is where the stop loss was 102, but against that we were able to make 1:2 profit level again. Likewise, you can identify these opportunities every day. There will be time where you can spot these opportunities and trade just on the basis of these 2-3 indicators so far. You'll not be correct 100% of the times, but with a 1:2 risk to reward ratio, I said you just need to win 4 out of 10 trades, which is very much possible in this scenario. If you are able to win only 4 out of 10, you'll be profitable at the end. We've looked at 3 opportunities in 3 days and all were profitable. Let's look at one more day. On the 2nd, the price was below the moving average, so we are always going to sell. Parabolic SAR said sell on the 2nd, 9:25 or 9:30 AM. So we are going to sell at this point where the parabolic SAR said sell. I'll keep my stop loss on the high of the previous candle and let's see where the target goes. So it went down to up to this point. So the risk was 135 points and in return we got 435 with a risk to reward of 3.2. It gave a second sell signal that day if you want to take multiple trades. So it gave a sell signal here. I'll sell at this point, keep the stop loss at the high of the previous candle and look at where it went. Go downside. So up to this point. So the second one was just about a risk to reward ratio of 1:3. But still, it was profitable because the stop loss level did not reach until the end of the day. So even if I had closed at the end of the day, I would have made some profit. Some days you will get multiple opportunities like this. Some days you will get probably just one opportunity like this. What we need to make sure is we are winning at least 4 out of 10. There could be times where incorrect signals will be generated in the market, but that is why we have a buffer of 6 losing trades on 10 trades. This is by just using only 2 things, trend and momentum. In order to make it more perfect, right? So let me just hide all these indicators so that you can see the trades that we have taken. So this was the trade we took on 5th and went ahead and gave us a profit. This was a trade on the 4th. Then you have, this was the trade on the 3rd. There are 2 trades on the 2nd of July. Both were profitable. And you can keep looking at the number of trades in the past and see how effective this trading system is. In order to make it more accurate, what we can do is we can add another indicator here, which is the best of the lot. The name of that indicator is squeeze momentum. So just go to the indicators tab and type squeeze momentum and select this one, the first one. Squeeze momentum by developer called Lazy Bear, which is being used by almost around 89,000 people. Once we apply this, what happens? There's a new setup that pops up below the chart. And it is intuitive enough to read. Red means momentum on the downside, green means momentum on the upside. So all we need to do is make sure with the previous rules, like the price is below the moving average, that means a downtrend. So I will only take a red signal. Parabolic SAR was also red. So we had double confirmation. One confirmation of the trend, second confirmation of the momentum. We can also take a third confirmation of this squeeze indicator. It was also saying that the momentum is building on the downside because you can see it is increasing. And after a point in time, it started to reverse. That means the momentum is now reducing. So as soon as you see the momentum is reducing, you should exit your trade. If I enter here, I should have exited at this point, probably at this level. What this helps you identify is your exit position, not the entry. Entry is given by the moving average and the parabolic SAR that this is where you should have entered because the price is below the moving average and parabolic SAR both saying sell. But where should you exit? Till the time the momentum is increasing, it is good. But as soon as it starts to decrease, you should exit from your trade. Or you can exit based on your risk to reward ratio of 1:2 at least. So if 1:2 is reached, good. If not, then exit as soon as the momentum starts to squeeze, start to reduce. Because the price was below the moving average, we will not take the buy. We could have sold it here again. But you can see the momentum is very low in comparison to the previous momentum. So you can say this is sort of a sideways market. It is not moving much. There is not a high momentum in this case. That's how you can confirm your exits. We are confirming our entry through the moving average and parabolic SAR, and we are confirming our exits through either the risk to reward ratio if it hits the target, or through this indicator called a squeeze momentum, where we see if the momentum is declining, we exit it. One of the two, whatever happens first, either target or the momentum drops. This way, you can find many profitable trades. You can find at least one profitable trade every day. All you need to do is understand how the price movement works. I've just given you an example of a couple of indicators and a trading setup that you can use effectively. But this is something that might work, might not work. If you are following a risk to reward ratio of 1:2, even if it works 4 out of 10 times, you'll be profitable at the end of the month. But there are many false signals that can be generated, and you might end up hitting stop loss consecutively a lot of times. So you have to understand why the prices are moving, look at the news, look at some announcements that happens, right? If there is any specific announcement, particularly for an industry like RBI announcing repo rates, or maybe some restrictions applied by SEBI. So those are going to impact the financial market. So bank stocks and finance stocks are going to have a lot of impact. GST announced, let's say, exemption for agricultural products. Then maybe fertilizer stocks are going to go up because there's a positive news for that. So you have to find different information from around you if you want to make it profitable, and if you want to take it as a career, or maybe as a mainstream income source. Then this is not sufficient enough what we've discussed. You need to know a lot more, and all of this, whatever we've discussed, can be coded. So all of this, whatever we have seen here, we can code it. There is a coding script here, which is called as Pine editor. So this is a Pine language, a language of TradingView. You can code it, and once it is coded in TradingView, it can be automated to any of the Indian brokers. Most of the Indian brokers today have trading setups that can be automated through TradingView. So this was all about the trading setup that I wanted to discuss as a part of this webinar. Let me go back and see if there are any questions posted by anyone. Understand the logic for SL, but what is the parameter for TP? So Shankar, maybe I'm now clear how to find the parameter for exits, the profit level. Are these indicators available with Indian stockbrokers also? No, Ashwin, they are not. They are specifically available on TradingView only. They are not available with Indian brokers. You have to go to TradingView in order to use them. TradingView with the free version lets you use 3 indicators maximum at the same time. If you want to use more than 3 indicators on a particular chart, then you'll have to buy a premium subscription. So I am on a premium subscription. That is why I'm able to add multiple indicators at the same time and analyze it. But with the free version, you can add maximum of 3 at one time. Also with the parabolic SAR, see, there are many parabolic SARs. So if I go ahead and search for parabolic SAR, you can see there are so many of them. Generally, what you will see with the Indian brokers is this one, where if I show you, this is how parabolic SAR will be shown with the Indian broker setup. Just small dots. You see these small dots here. It will not indicate any color. It will not indicate any buy or sell or something like that. So it becomes difficult to identify, which is why we are using the one which was built by a developer, a community developer, so that you get a more clear indication. And that is why TradingView is popular, because it is open source. Even we as Investor Academy has developed an indicator and we are using it that is based on machine learning. So if I go and add that indicator, so let's say I look, so these are all the indicators that we are trying to develop, and the one that we have at the moment is the investor, this one. So I add that, the Investor Academy. It is based on machine learning and artificial intelligence, which generates a buy and sell signals. It's loading at the moment, and now you can see if I remove everything else, you should be able to see purely this indicator that you see a trend line, and you can see these arrows that indicates buy and sell. And on the top of your screen, you can also see the accuracy of this indicator that we have at the moment on this particular time frame and on this asset. So again, the trend line indicating red means it's on a downtrend. Then it went to sideways, giving us buy and sell signals, on the basis of which trades can be taken. So indicators are something that anyone can develop and publish on TradingView, as long as you have knowledge of Pine scripts. Yeah. So any other questions we have? So I hope this webinar was useful and you were able to get a idea of how to build some basic strategies on the basis of technical analysis of the movement of prices. And again, saying this was just an experimentation that I've been trying, and it's turning out to be very useful for me. So it's not a investment advice, or it's not something that I'm saying you can follow and make profit always. Every system has its own pros and cons. So you have to understand all the advantages and disadvantages associated with any trading system and then use it. Will make it profitable and consistently is when you understand things about the market and a lot more technical side of it, like candle patterns, chart patterns, and all the other things that I mentioned before. These ones. These are just the basic ones. There are more advanced ones that you need to understand. So you have to take a confirmation from multiple sides and then probably go for it. Right, so this is what you can do yourself. But if you want us to manage your portfolio or to apply these algos to your account, we currently are running a bonus. Right, you must have seen we are giving you margin against your mutual fund holdings, which is where you can earn from two sides by investing just once. So you already have an investment in mutual fund which will continue to grow, and you can use that money simultaneously for algo trading. So for anyone who is signing up in the next 24 hours, we will go ahead and reimburse you for all the charges that will be occurred with that margin. Right. So after the end of the webinar, you'll be redirected to a simple form which you can fill up if you are interested to start algo trading with us. And if you want to know more, you already have my contact. You can give me a call or send me a message and we can connect and discuss. Is allowing 2 indicators. Okay, maybe they have reduced it to 2 indicators now. Previously it was 3. Just out of curiosity, what percentage of your trades are profitable? So Ashwin, we don't really use one trading setup. We use multiple trading setup. Normally, our win rate is somewhere around 60-40, 60% win rate we have across all the trading strategies that we have on an average. Some strategies gives us a 30% win rate. Some strategies give us more than 90% win rate. So on an average, we have somewhere around 60% win rate combined everything together. Okay. Any other questions before we close? If you want to find such more trading setups and useful information about market and algo trading, do subscribe to our YouTube channel. I've recently started that. So I will keep posting some useful information there. Short videos of about 5 to 10 minutes that will be extremely useful for understanding market and how we can trade it. Everyone's reference, I'm sharing the link of the YouTube channel again, but it is already on the poll too. So with that, thank you so much for joining the webinar today. Recording will be available and will be sent to your email. So you can also go through the recording. It will also be uploaded to our YouTube channel as well. You can look at the recording on the YouTube too. Fine. So you'll be redirected to a form once I end the webinar. Do feel free to complete that form and I'll get back to you and connect and discuss. So take care. Good evening. Bye-bye.